Robinhood just hit a $100 billion market cap. The stock has exploded more than 300% in the past year. And Wall Street is suddenly treating this old meme stock app like a serious AI fintech platform. So here is the real question. Is Robinhood becoming the default financial app for the next generation of investors? Or is the market pumping up another retail trading bubble that could pop the moment activity cools down?
That is the right question, and the answer is not simple. The bull case has real merit. Robinhood is no longer just the app people used during the meme stock boom. It has deposits, subscriptions, crypto, options, retirement accounts, credit products, and now a fresh AI story. But there are three red flags most retail investors cannot ignore: valuation, trading cycle risk, and whether AI can actually change the economics of the business.
We will break this down in three parts. First, why bulls believe Robinhood is becoming a full financial super app. Second, why bears think the stock is already priced in too much. And third, the four numbers that will tell us whether this is a real platform transformation or just another hot market rating.
Let's put the numbers on the table. In Q1 2026, Robinhood reported revenue of about $1.07 billion, up 15% year over year. Net income was $346 million. Net deposits were $17.7 billion, and Robinhood Gold subscribers hit a record 4.3 million, up 36% from a year earlier. That is the part bulls love. Users are not just opening the app and leaving. Money is still coming in. Gold subscribers are growing. The platform is getting deeper. Exactly. The strongest bull argument is that Robinhood is turning from a trading app into a financial ecosystem. Assets matter because they show trust. Net deposits matter because they show users are adding money. Gold subscribers matter because subscription revenue is more stable than pure trading revenue. And product expansion matters because every extra product gives Robinhood another way to monetize the same customer. If a user starts with stock trading, then it's options, then it's crypto, then uses cash sweep, then subscribes to gold, then opens a retirement account, then uses the credit card, Robinhood becomes harder to replace.
That is the platform argument. But the part that gives this stock its new hype is AI. Robinhood has been talking about AI tools, agentic trading, personalized research, portfolio digests, prediction markets, and more advanced trading features. For a normal brokerage, that sounds like a product update. For Robinhood, the market hears something bigger: the possibility that AI turns the app into a personal finance assistant for millions of users.
That is why the AI angle matters, but we have to be precise. AI can help Robinhood in three ways. First, it can make research easier. Instead of forcing users to read full earnings reports or analyst notes, AI can summarize what matters. Second, it can increase engagement. Better alerts, smarter dashboards, and personalized insights can make users open the app more often. Third, it can create a new product category. Agentic trading is still early, but the idea is powerful. Users connect AI agents to dedicated accounts with safety controls, and those agents can analyze portfolios, surface ideas, and potentially execute trades. That is a very different story from the old Robinhood.
But this is also where the risk starts. AI tools sound exciting, but for shareholders the question is simple. Do these tools actually increase revenue, retention, assets, or profits? If AI is only a feature, it may improve the app. If AI changes how users interact with their money, it can change the business. The market is already pricing in some of that second scenario.
Right, and that is why the valuation matters. Robinhood now trades around a mid-50s PE. That is not broken fintech pricing. That is not deep value pricing. That is growth pricing. At that valuation, Robinhood has to prove several things at the same time. It has to keep growing deposits. It has to keep gold adoption moving higher. It has to keep users active. It has to expand globally. It has to make AI useful. And it has to do all of that without letting expenses run too far ahead of revenue. The stock is no longer being priced for survival. It is being priced for execution.
So the question becomes, what is the real engine here? Is Robinhood growing because the platform is getting stronger? Or because markets are hot and retail traders are active again?
That is the key. Robinhood still has major exposure to trading activity. Options, crypto, equities, margin, and event contracts can all benefit when users are active. When the market is in risk-on mode, Robinhood can look extremely strong. But if crypto cools down, volatility falls, speculative trading slows, or retail traders step back, transaction revenue can lose momentum fast. This is the bear case. The market may be treating Robinhood like a stable platform while the business still has a lot of cycle risk.
The crypto piece is a good example. Crypto can bring users, trading volume, and attention. But crypto revenue can move sharply with sentiment. A strong Bitcoin market helps Robinhood. A weak crypto market can take that tailwind away. That makes the business exciting, but it also makes earnings less predictable.
And the competition is not easy either. Robinhood is fighting several battles at once. Traditional brokers have scale and trust. Coinbase has crypto identity. Sophie wants the same young financial customer. Cash App already has massive consumer reach. Interactive brokers own serious active traders. Schwab and Fidelity still control enormous asset bases. Robinhood has a cleaner interface and a younger brand, but it has to keep earning trust.
Trust is still important because Robinhood carries the memory of the meme stock era. Some users still remember trading restrictions, regulatory scrutiny, and the sense that retail traders were left exposed during extreme market stress. That does not mean the company cannot grow past that. It clearly has. But if Robinhood wants to be valued like a long-term financial platform, it needs to prove customers trust it with more than short-term trades.
That is why the Gold subscriber number is so important. 4.3 million Gold subscribers is not just a vanity metric. It shows that a meaningful group of users is willing to pay for a deeper relationship with the platform. Gold gives Robinhood a more recurring revenue stream. It also gives the company a way to bundle value, better cash rates, retirement match features, research tools, margin benefits, and potentially AI-powered tools. If Gold keeps growing, Robinhood becomes less dependent on pure trading volume.
And net deposits are the other major signals. $17.7 billion of net deposits in Q1 tells us money is still entering the platform. That matters more than a one-day stock move. If users keep adding money, Robinhood's base gets stronger.
Exactly. In fintech, deposits and assets are the foundation. Daily active excitement gets headlines. Assets under custody create the long-term business. If Robinhood can keep attracting assets from younger users, then the lifetime value of those users can grow for years. A 25-year-old user with a small account today can become a much more valuable customer over time. That is the long-term bull case. Robinhood is trying to acquire the next generation before the old financial institutions do.
So what would make the bull case stronger from here?
4 things. First, assets under custody need to keep rising. That proves users are not just trading and leaving. Second, net deposits need to stay strong. That proves users keep funding accounts through different market conditions. Third, Gold subscribers need to keep growing. That proves Robinhood can build recurring revenue. Fourth, AI tools need to show measurable impact. The company needs to show better engagement, better retention, higher revenue per user, or stronger product adoption. Without those numbers, AI stays a story. With those numbers, AI becomes a business driver.
And what would break the story?
3 things. First, if trading activity slows and revenue growth loses momentum, the market will question the valuation. Second, if expenses rise too quickly because of product expansion, AI investment, global growth, or acquisitions, profit growth could disappoint. Third, if AI products do not create clear user value, the market may decide Robinhood is still mostly a trading cycle business. At a P around 55, disappointment can hurt.
That is the clean risk. Robinhood can be a better company than it was during the meme stock era. And the stock can still be expensive if expectations get too high.
Exactly. The company has improved. The product is broader. The financial metrics are stronger. The brand still matters. The AI and global expansion story gives investors a fresh reason to look at the stock. But the market is already paying for a lot of that progress. A $100 billion market cap means this is no longer a small fintech comeback story. It is a major growth stock with real expectations.
So the final debate is simple. Bulls sees Robinhood becoming the default financial app for younger investors with AI, subscriptions, crypto, trading, retirement, and global expansion all working together. Bears sees a stock that has already run hard, trading at a high multiple, with revenue still tied to market activity and retail appetite risk.
That is the right frame. Robinhood is no longer just a meme stock app, but it is also not a proven financial super app yet. The next few quarters have to show whether this is a real platform transformation or just another hot market rating.
Final takeaway. Robinhood's story has changed. The question is whether the economics have changed enough to justify the price.
For educational purposes only, not financial advice.